Welcome to this session. My name is Barbara Gochalia, and we are continuing from where we stopped. We are looking at market failure, and we saw that market failure is caused by a number of factors. And our first cause of market failure that we looked at was the presence of externalities. And we saw what externalities meant. We looked at both positive and negative externalities in production and in consumption. And we saw ways in which the government internalizes these externalities. Now, let us look at our second cause of market failure, number 2, which is the existence or the presence of public goods. Now, just for a recap, we saw that market failure arises when there is inefficiency in the resource allocations, inefficiency in the market in terms of resource allocation. So the fact that the private sector or the free market economy cannot provide these public goods to the level of optimal efficiency, optimal mix of resources, then it requires the government to come in and provide these goods, right? So let us look at what we mean by a public good, and thereafter we shall get to know why the presence of public goods become a market failure. So a public good is a good that is basically characterized by two characteristics. It is non-rival in consumption and it is non-excludable, right? So a public good is a good that is non-rival in consumption, literally meaning that the consumption of a public good does not, the consumption of a public good by an individual that does not reduce the amount available to other individuals, right? It does not reduce the amount available to other individuals. For example, street lights. If we have street lights, that is a public good, because even if very many people are using the street lights, it will not become dim because there are many people using it. So they use the benefit that an individual gets from using a street light does not reduce the benefit available or the amount available to other individuals. Then a public good is also non-excludable in nature. Non-excludable meaning that you cannot prevent anyone from using a public good. You cannot prevent anyone from using a public good. For example, another example of a public good is these public roads, right? Street lights, we have public roads, layways, right? Those ones are public goods. Then we have national defense and security. Those are examples of public goods. So basically a public good is a good that is characterized by two major characteristics. It is non-rival and non-excludable in nature. So let us look at examples of public goods. We have infrastructure, and under infrastructure, we have roads, we have sideways, street lights, power lines, sewerage systems, train tracks. All those are examples of public goods as long as they have that characteristics of non-rival and non-excludable. Then we have public parks, right? Those ones are also public goods. We have fire and police protection services as long as they are provided by the government and they have those two characteristics. Then national defense and national security. Those are examples of public goods. So someone maybe would be asking that, what would make these public goods, what would make the presence of public goods an externality? And we've already looked at that briefly, that the fact that, for example, the fact that the private sector or the free market cannot provide these goods efficiently makes the government be able to come in to provide these goods to bring about allocative efficiency or optimal allocation of resources. For example, look at the security, national defense. You realize that even though they are private companies that provide security services, these private companies, first of all, they offer the security at a price, right? At a price which is costly to most of the people. And in fact, most of the people cannot afford to pay these security private companies to offer them security. So because that one brings about inefficiency in terms of allocation of security services for the citizens, then it necessitates the government to come in and provide national security. So that's why the presence of public goods are, that's why when these the free market fails to allocate these resources, then the government comes in to provide these goods. So the presence of public goods shows that the market has failed to offer these goods efficiently. And the third cause of market failure is common access resources, And the common access resources basically are what we call the gifts of nature. In other words, those common access resources, they do not have, there is no private ownership for for common access resources. For example, if you look at the fish in the sea, who owns the fish in the sea? The trees in the forest, who owns the trees in the forest? Common pasture land, who owns that one? Fresh waters in aquifers or rivers, who owns the water in aquifers or rivers? So those ones automatically become common access resources, right? So the fact that these common access resources, they are characterized by not having a private ownership, it means that it is a market failure, and we are going to see why it becomes a market failure. Of course, it becomes a market failure because there will be characteristics of rivalry, right? And excludability. There will be characteristics of rivalry and excludability concerning using the benefits gained from using these common access resources, right? So let us look at what we call the tragedy. So with these common access resources, basically what happens is that because there is no private ownership, at the end of the day, we are going to have characteristics of rivalry and the excludability. In terms of the number of people using these common access resources, we shall have what we call, we shall have a problem called the tragedy of the commons. Now, the tragedy of the commons, we are talking about the tragedy of the common access resources, the tragedy of the common access resources. And Garrett Hardin was a US ecologist, right? Was a United States American ecologist that actually wrote a famous essay that in 1968 that was entitled The Tragedy of the Commons, and he was actually talking about the tragedy of the common access resources. And in his essay, he talked about these common access resources that we've looked at. He talked about, for example, common pasture land. And he said that with a common pasture land, for example, where we have animals grazing on the common pasture land with their pastoralists, he said that that if it so happened that there was overcrowding on this common pasture land by these animals as well as the pastoralists, that he said that if there was calamities like diseases and poaching and the tribal wars, right? And tribal wars, then it means that this will reduce on the population, on the population of these animals, right? Or on the population of both man and beast. And therefore, this would create room for more animals to be kept on this common pasture land, right? However, he said that if people continued, he said that if these pastoralists were grazing these animals on these animals, like cattle, for example, on this common pasture land, they would get benefit, they would get a utility of, for example, if they sold an extra animal, right, that is grazed from this common pasture land, they would get revenue. But at the same time, he says that if at the same time, he says that there was also that this benefit, however, would be counteracted. It would be counteracted by negative consequences like overgrazing and soil erosion, right? Because if these animals were grazed in the same place, then it means that we would have problems of overgrazing and soil erosion. So he said that the benefits would be offset by the positive benefits would be offset by the negative benefits. However, he said that because there was no private ownership of these common access resources like these pasture land, common pasture land, he said that it will lead to, for example, to overcrowding, overgrazing, and it will lead to rival among these pastoralists and the animals that were on this pasture land. So at the end of the day, the ruin that would be brought as a result of using these common access resources like the common pasture land is what he called the tragedy of the commons, is what he called the tragedy of the commons. He also talked about national parks, right, as an example of the common access resources, and actually he gave solutions, and his solutions were basically two, and he said that what shall we do? Yeah, what shall we do to solve this problem of the tragedy of the commons? And he said that one of the solutions was to sell off these common access resources and to make them to make them a public to sell them off such that they become a private property, because selling them off and becoming a private property would definitely bring about private ownership of these common access resources. Remember, we've seen that these are resources that do not have private ownership. So the solution will basically be to sell them off as private property, right? And then also he gave another solution whereby a price needed to be charged on these public on these common access resources, which were basically as public property like the national parks. And he said that a charge needed to be put on these common access resources, such that people would attach a value on these common access resources. Garrett Hardin went ahead to talk about pollution. He went ahead to talk about pollution. He talked about water pollution. He talked about air pollution, and he also devised the solutions. And the solutions, basically, he was giving, for example, for the pollution, you can imagine he gave the solution of for example, using permits. Yes, using the tradable permits, which we already looked at as one way of responding and government internalizing negative externalities like pollution, negative externalities in production like pollution. So even Garrett Hardin talked about water pollution, air pollution, and he also went ahead to divide solutions for air pollution. For example, he said that the tradable permits needed to be used, right? So for the common access resources, Garrett Hardin provided solutions and to the tragedy of the commons, and he basically talked about privatizing these common access resources such that there is a private ownership. He talked about government management of these common access resources, right? And he also talked about using of tradable permits, for example, for air pollution. Let us look at the fourth cause of market failure. The fourth cause of market failure is what we call asymmetric information. Asymmetric information, or it can even be called imperfect information. So with asymmetric information, it means that if we have two parties, the buyer and the seller in the market, one of the parties, it means that one of the parties knows that part of information, which, for example, it could be the seller that knows that part of information in the market, and the buyer does not know about that information. Or the buyer knows about some information in the market, but the seller does not know. So it means that only one party knows. Asymmetric needs partial information, right? Only one party in the market knows information in the market that another party does not have, right? So how does it become a market failure? Remember, we saw that, or just a recap, with a free market, there is a free and transparent information. One of the characteristics of a free market is that it has free and transparent information, or there is no perfect knowledge. There is perfect knowledge about the goods and the services in the market, right? The buyers and the sellers have perfect knowledge about the goods and the services sold in the market. So the fact that if there is no perfect information in the market, then it means that is a market failure. And remember that the market failure also means that anything that violates the characteristics of a free market economy is a market failure. Anything that violates the characteristics of a market economy is a market failure. Remember, we saw that with a free market economy, that which we also call the laissez-faire market economy, it is only in that free market economy that we attain allocative efficiency. And allocative efficiency means that we are operating at an equilibrium. In other words, there is no excess supply of goods and services, and there is no undersupply of goods and services. And remember, we saw that market failure arises either when there is excess supply of goods and services, or when there is undersupply of goods and services. Remember, we saw that for the externalities, we saw that the negative externalities are always oversupplied in the market, and we saw that the positive externalities are always undersupplied in the market. Right. So with information, with the asymmetric information, it becomes a market failure. And here, well, because it's a market failure, it leads to the arising of certain problems. Yeah, it leads to arising of problems like adverse selection and the moral hazard. Right. Asymmetric information leads to the arising of adverse selection and moral hazard. So with the adverse selection, we are going to look at an example that will help us to understand the meaning of adverse selection. Now with adverse means when you do an adverse selection, it means you have made a wrong selection, right? So this practically happens between buyers and sellers. So we are getting an example whereby a buyer, right? Let's assume maybe a buyer, there is someone who wants to buy a car and goes to a car bond, right? So if you want to buy a car and you go to a car bond, and maybe the fact is that you do not know enough information about what happens in this car bond, about these people that sell the cars. You do not have enough information about them. So when you go to buy and they sell you this car, after you have paid it, and then after some time, what happens is that after you have paid, of course, they will check the car and it's okay. But after some time, then you realize that as you use this car on the road, it begins to break down. It begins to get technical faults all the time. You're repairing it just a few weeks after you bought the car. So it means that you are suffering the consequence, as a result of not having enough information. Maybe if you got enough information that these car sellers in this car bond, con men, they are not faithful people, then you wouldn't have entered into that car bond to buy that car, right? So it means that because the seller is not happy, because the buyer is not happy with what they have bought, with the item they have bought, then it means that there is market failure, right? Because basically with the free market economy, it is where we attain what we call allocative efficiency. And allocative efficiency means that consumers are getting satisfaction for the goods they are willing to pay for. Allocative efficiency means that consumers are getting satisfaction for the goods they are willing to pay for. So in this perspective, if the buyer is not happy, is not satisfied about the commodity they have bought, the item they have bought, then it means we have market failure, right? Then moral hazard also happens as a result of asymmetric information. Now, moral hazard, we are also going to look at an example, and from there, we shall also understand what moral hazard means. So still here in the market, we have the buyer and the seller. So let's look at an insurance company as the seller, right? Let us look at an insurance company as the seller and their client as the buyer, right? So what happens here is that these insurance companies, they have some commitments that they make, that they would do. Of course, the client pays an insurance premium maybe every month. So what happens is that, for example, if it is what you call third party for the vehicles, right? If this insurance company promises this person, their client, that if your vehicle got an accident, we shall compensate you. And what happens is that they have a lot of strings attached, right? So they do not explain well to their client. And as a result, if it so happens that this client does not get a car accident, then it means that these insurance companies, they will not pay, they will not compensate this client of theirs. So with moral hazard, basically because of some of these insurance companies not providing enough information to their clients, what will happen is that if a client has not got an accident, a car accident, they will try to fake a scenario where they will fake a scenario that they've got a car accident. Maybe they will even use wrong photos to show that they've got a car accident just for reasons of being compensated by the insurance company. So because of that, we see that such scenarios happen because such a scenario could happen, and you find that the insurance company is even compensating this client, but this client is even deceiving or faking a scenario that he got an accident and yet he didn't. So such happens because of asymmetric information, because maybe the seller did not provide enough information to the buyer. So all those happen, the adverse selection and the moral hazard, they happen as a result of asymmetric information. All right. So with the causes of market failure, for a recap, we have looked at externalities, we looked at public goods, we've looked at open access resources, we've looked at asymmetric information or imperfect knowledge or imperfect information. Right? So let us also look at another example of what happened as a result of a market failure. And this market failure was basically asymmetric information. So because of asymmetric information, we had scenarios like the global financial crisis. So the global financial crisis that is also known as the credit crunch was a result of a market failure, whereby we see that it all began in the United States of America, where we see that banks in the US gave out loans. They gave out subprime loans, right? They gave out some prime house loans, right? Whereby people got these loans to for real estate, yeah. They got these loans to make to build this real estate. And what happened is that these borrowers knew that when they get these subprime loans to build this real estate, they will make interest. But what happened was that they didn't. What happened is that they miscalculated, right? And what happened was that now the housing prices were now low. The housing prices were now low, and they could not now service the loans that they had got from these banks. The housing prices became low and they could not service these loans. And as a result, the banks were now making bad debts. They were making bad debts. They were making losses. They were making what we call bad assets on their balance sheets. So this led to a financial crisis on the side of the banks. And this financial crisis now, given the fact that the USA is a superpower, it began now spreading to other parts of the world. And it actually became a global financial crisis. But basically, it arose as a result of asymmetric information, because little had if these borrowers that had borrowed this money for the subprime loans to invest into the real estate had known, they wouldn't have done so. But because they did not have enough information in the market, then they miscalculated, and the result was the financial crisis that became global. So all that happens because of asymmetric information in the market. Let us look at market failure number 5, and that is the presence of imperfect market structures. The presence of imperfect market structures. And any market structure that is not perfect competition is called an imperfect market structure. Any market structure that is not perfect competition is called an imperfect market structure. So monopolistic competition and oligopoly, those ones are imperfect market structures. You have to know that we have to know that perfect competition or is actually the free market economy, and it's only in perfect competition that we attain allocative efficiency or optimal allocation of resources. So let us look at monopoly as an example of an imperfect market structure. So someone would be asking, how is the presence of imperfect market structures like monopoly, how does it become a market failure, right? So we know that, or maybe we shall get to know more when we get to market structures. So monopoly basically is a single seller of a product that does not have a close substitute. A monopolist is a single seller of a product that does not have a close substitute, right? So because of that, a monopolist is a price maker, and a monopolist is a price discriminator. And under monopoly, high prices are charged and yet lower output is produced, which practically leads to inefficient allocation of resources, right? So as long as there is inefficient allocation of resources, then we have market failure. We have market failure. All right. So with the exploitation of consumers through price discrimination, low output being produced, high prices being charged. Remember that a monopolist experiences an inelastic demand curve. An inelastic demand curve, it's actually a fairly inelastic demand curve when you draw it. But practically, when we say, in most cases, when we say inelastic in economics, we mostly refer to fairly inelastic demand curve, right? Practically meaning that when a monopolist increases the price by a higher percentage, a higher proportion, the change in the quantity demanded, or the reduction in the quantity demanded, will be very slight, will be very small, right? Why? Because there are no close substitutes for that single product that a monopolist is selling. So the question is, if we have this market failure as a result of these imperfect market structures like monopoly, then what happens? How is this solved? So that's how we see that the government comes in to respond to these market failures, right? For the case of monopoly, what the government does, it comes in and it will regulate these for example, monopolists, right? So we have already seen that with a competitive market, which is a perfect competition, or a free market economy, or what we call a laissez-faire market economy, it is that market structure that we attain allocative efficiency, where we attain practically an equilibrium, and that equilibrium means no excess, no under supply of resources. So once that is not happening, what happens is, with these imperfect market structures like monopoly, what happens here is that a monopolist will produce below, right? The output produced by a monopolist is below the optimal output that should be produced in the market. So for example, if this E naught, if we consider this to be, for example, E naught, right, as the optimal, the equilibrium, actually, E naught as our equilibrium, that actually gives us an optimal output produced in the market here, right? So practically what happens is that this is the demand curve of a monopolist, right? That demand curve there is the demand curve of the monopolist. And this is the demand curve under perfect competition. This is the demand curve under perfect competition. That is the demand curve under monopoly. All right. So of course, if this demand curve for monopoly is below the demand curve for perfect competition, it literally means that under monopoly, the output produced is less than what is produced under perfect competition, or it's less than what the optimal output produced should be. And therefore, we have under supply of resources, under supply of resources or output produced in the market, which basically brings about a market failure, right? So because of that, we see the government comes in to regulate these monopolies and the other imperfect market structures, of course, like oligopoly. And we shall be seeing more what the government does. But one of the ways is that the government can use what you call antitrust laws, which will be basically laws that encourage competition. Antitrust laws that will basically be the laws that encourage competition. These will be laws that discourage and abandon the formation of trusts, and these trusts are basically for example, collisions by firms under oligopoly. Trusts can be mergers. These trusts can also be mergers. They can be collisions. They can be what we call anti-predatory. They can be what we call predatory pricing, right? We shall look at the details when we come to market structures. But basically, the government will use antitrust laws to encourage to discourage the formation of trusts like cartels, like mergers, like predatory pricing, like collisions, and encourage competition. And when competition is encouraged, of course, output increases and the price is lower. So remember that we've seen that with monopoly here, the output will be below. The output here will be below than the optimal output. The optimal output produced at that equilibrium, and even the price will be higher than the optimal price. Yeah, so that is the price of monopoly here, right, which is higher than the optimal price there for perfect competition. And this is the output of monopoly, which is literally less than the output produced under perfect competition or the free market economy, right? So the government comes in and imposes antitrust laws as a way of discouraging, regulating monopolies. And also the government can use what we call deregulation, whereby it will privatize some of these government monopolies, basically to bring about efficiency in terms of provision of these goods. So in case there is any question, feel free to raise your hand and ask. Any questions so far? So that was the presence of imperfect market structure as a cause of market failure. Another cause of, actually our last cause of market failure that we are looking at is inequitable distribution of income. Inequitable distribution of income or inequitable distribution of resources in the market. Remember that when there is the free market economy, is when we have allocative efficiency, right? It means that there is optimal allocation of resources, right? There is optimal allocation of resources. But if there is no optimal allocation of, by optimal, we mean we are operating at an equilibrium, no excess, no undersupply. So if that is not happening, then it means that you have inequitable distribution of resources, inequitable distribution of income in the in an economy practically. So what happens then, right? So of course, like we've already seen the different causes of market failure. We even know that we now know that even the presence of imperfect market structures like monopoly will lead to inequitable distribution of resources, whereby we shall see that most of these owners of these monopolies, they'll have more, they make abnormal profits. Monopolist makes an abnormal profit, so they become richer, and whereas the poor are becoming poor. So that income gap is what we call the income inequality. So in order to bring, that is a market failure. So in order in order to bring about efficiency in the market, that's when the government now comes in to eliminate that in income inequality. And one of the ways it actually does that is taxes, through taxes and transfers, right? So it will tax, for example, the rich. It will impose higher taxes on the rich than on the poor to practically bring about equitable distribution of resources, equitable distribution of income. For the developed countries, for them, they have what you call income transfers, right? Income transfers, provision of, for the developed countries, they provide income transfers, like a provision of unemployment benefits to those people that are working, are not working, sorry, right? So we've looked at basically 6 causes of market failure, and we've seen that when the market fails, and those causes of market failure basically are what we call micro market failures. Micro market failures. So when we experience those micro market failures that we have looked at briefly, the externalities, the public goods, the open access resources, perfect asymmetric information, the presence of imperfect market structures, income inequality, those are micro market failures, and those ones are solved when the government comes in to intervene. The government comes in to intervene, and we've seen different measures that the government does to intervene and curb those micro market failures in order to bring about efficient allocation of resources. However, even the government in its endeavors, to deal with the micro market failures, it might also fail, right? So basically, with the goals of the government coming in to solve to curb the micro market failures, it basically has goals of basically fostering economic growth, of getting us on the production possibility curve and be able to bring about full employment. It also aims at bringing about stable price levels, bringing about maintaining a stable price level. Remember that, for example, with the presence of monopoly, the prices are high, the output is low. So when the government comes in and regulates and deregulates these monopolists, then it is practically encouraging competition to bring down the prices and increase output. Then also with the government intervening to curb with these micro market failures, it wants to increase the capacity to produce. It wants to increase the capacity to produce. However, we realize that the government, in all its endeavors to curb the micro market failures, it can also fail. It can also fail in its endeavors as it tries to curb the micro market failures. So these are the causes of the micro market failures that we have looked at. And when it fails, when this government fails to curb the micro market failure, then we call it government failure. We call it government failure. So we have already seen that the government can fail to allocate resources efficiently, what we call market failure. And with the micro market failure, it's the government that comes in to curb and solve and respond to the micro market failures to bring about allocative efficiency. But even the government, in its endeavors to curb the micro market failures, it can also fail. It can also fail. And when it fails, then that becomes a macro failure, which is practically called government failure, which is also practically called government failure. So the government can also fail, as like we've already seen in its endeavors to intervene to curb the micro market failure. It can also fail to improve the economic outcome, right? It can also fail. And the challenge mostly is because of the public policy. Sometimes the government policy is also against what the government is intending to do to solve the micro market failures. All right. Thank you for listening. Until next time.